You're watching Master Trader Live, simple market analysis and education to help you make money in the markets. Join us live each week on YouTube and see past episodes at Master Trader Live. And now your show hosts, Greg Capra and Dan Gibby. You're watching Master Trader Live, simple market analysis and education to help you make money in the markets.
All right.
Join us live.
Once was enough. I can't stop it now.
At Master Trader Live.
All right,
And now your show hosts,
Oh, I see what's wrong.
and Dan Gibby.
All right, welcome everybody. Of course, it's Wednesday and why we're all here. And today we're going to be talking about option strategies related to day trading. I like that, especially when it comes to options. They offer many opportunities as a vehicle to make money. And personally, if I can make it faster, all the better. And so as we use options, there are different elements of them. We were kind of discussing that today in the green room, as far as utilizing options this morning on this gap down. And one of the things we discussed was, from my own point of view, I want to trade the futures in the morning. One of the things you find out with options, because of, especially when we're going to talk about options that expired today, because of the time decay, that extra time, right? To zero in on the most opportune pattern sometimes plays against you, as the time decay can play against you, but it can also is on your side in a big way, especially when they expire the same day. So it's all really interesting, the different moving parts related to options. And, once you understand them, how to utilize them together is always the key. Even as we use our concepts for swing trading, day trading, and investing, we utilize different, what we call concepts, to create a thought building process. As we put those concepts together, they put the odds in our favor more and more. There's a balancing act as to how much to have in your favor and waiting too long. So no further ado, let's not wait any longer and get to the meat of this.
Hey, you're a good juggler. Let's go. Yeah, welcome everybody. Yeah, that's going to be a fantastic session here. We buy and sell options, and we're going to focus on a very simple day trading option today, which is, of course, we buy options, but today we're going to focus on selling options, because the beautiful thing is we're just calling a short-term top or bottom for a couple hours, and we're putting money into our bank account, which is ours to keep as long as the pattern plays out as intended. But let's just do a little bit of introductory definitions here, just in case you're not familiar with options. Let me get my spotlight. So when you buy an option, what the heck does that mean? Well, I'm going to the option market, I'm paying money, and that gives me the right to buy or short the underlying at an agreed upon price before the expiration date. Okay, so that's, and we do that too when we have a directional setup. But now the seller of that same option, we're going to receive that money, and we have a corresponding obligation to fulfill the buyer's rights. So if we're going to sell puts, you're going to see we have an obligation to buy, which we're going to do on bottoming patterns. If we're shorting calls, we have an obligation to deliver, to sell the underlying, and we do that at short-term tops. This is our strategy. We literally get paid through this time decay that Greg mentioned in the intro, and we love selling short-term expiring options, typically 10 days or less, because of the time value component, the way options erode in value. So today's session is like a snippet of that. We're selling these options just for hours, not for days, for hours. And throughout this, we'll talk about misleading information that's peddled out there in the markets. So today we're going to talk about shorting 0 DTE, stands for days to expiration. Jumping right down here to the bottom bullet, you might say, oh, well, then that's only on a Friday, Dan, if it's a weekly, or it's a Thursday if it's a monthly expiration. Well, that part's true too. But the beautiful thing with spiders, the S&P 500 and the NASDAQ 100, both the ETF and the big contract, the futures, they have expirations Monday, Wednesday, Friday, and the Thursday monthly and quarterly expiration. So that gives us more opportunities to apply this approach that you're going to learn today.
Hey, Dan, question when you continue. Since you made us aware in the room that the Qs recently became available with 0 DTE options,
Right.
how long has that been going on? I mean, you mentioned it, I think, but how long has it been available?
I found it by accident, Greg, by wanting to short a Friday expiration Q, and I'm like, whoa, look, there's a 0 DTE option, and I tried to Google it, and I don't have the exact date, and
Right.
you know, hopefully, I mean, IWM, hopefully they're right behind, and you know, you made a comment this morning, Greg, which was so funny because you love selling these options, these options for 2 hours. You're like, I wish every stock had a 0 DTE expiration.
Absolutely. But now I see that you've got an NDX written down here, which I don't know if you looked at those.
Yeah,
and I'm interested. Are they like SPX? Because
yes, they are.
I mean, with that more leverage is what I mean.
Yeah. Yeah, because it's the big contract. Absolutely. So I just looked at IWM and no, they're not there yet. All right, let's continue. We got a lot of great information here. So think about this, folks. You know, some people say, oh, sell 45-day out of the money options. Well, you got 45 days of risk. We are doing the same concept, but we're just predicting a high or low for a couple of hours. This morning, we nailed the low in the Qs, and I see them chugging up here. What we do is everything starts with a compelling pattern. Then we do a stock or option trade. And if it's an option trade, is it a directional where we're going to buy options, or we're just calling a short-term bottom and we're going to sell options? The time decay, when volatility is high, we collect more money. Trade management, we'll show you a bunch of examples there. But once we enter one of these trades, we're in trade management mode. So as long as it's working like the Qs are today, you would do nothing. Just let it, you got your stop in place, we're trail stopping, and let it expire worthless. You could adjust if needed. We can hedge it if needed, maybe leg into a condor, which we're not going to talk about today. We can roll it to the next expiration, which on Qs, today's Wednesday, would be Friday. Let's just keep going here. In very simple terms here, right, Greg? You know, I keep telling you, Greg, we need to do an MT live on even an 8-year-old can trade using our method. These are the only things stocks can do. Uptrend.
So, Dan, let me take the opportunity because, you know, we've got a lot of people in the room here, and I don't know that we have a tendency to attract those that are a bit more experienced, but I know also there's so many on the internet that are looking to learn. So, I mean, Dan just mentioned what he's saying is to have something really basic about, you know, technical analysis and do an MT live on that. And I'm just curious, just by, you know, you guys just type in a 1, you know, would you be interested in something that covers the basic foundation of technicals the way we use it?
And even if it's not you personally, it could be for your your child. And Greg, it's interesting timing. In the Wall Street Journal today, they had an article that said Fidelity is now coming out with a program to go after kids. So they're doing exactly what we're talking about right now.
Yeah, they're trying to get ready to fill the bucket or the funnel by doing that, of course. Nothing wrong with teaching kids, but I taught mine many years ago, and they weren't interested when I tried to teach them. But my son especially had a project in school, something related to the stock market. And once he realized, I don't know why he didn't catch it at the beginning, but once he realized that this was money that he could spend on whatever, whether it's candy, toys, or whatever, that perked his interest.
Right. And you heard me talking about the collapse of the cryptocurrencies here over the last week, the last 7 days. A number of them are literally cut in half, 50% loss. And you have people, just loving crypto, but they don't use our approach to trade them intelligently. And if we teach our approach to young children, they might like Facebook, Google, McDonald's, whatever the case, and they might just want to arbitrarily go buy it. And we would talk to them about, hey, let's develop a little trading universe for you, and then go through what we teach. But yeah, I'm getting off subject here. So again, we keep things simple here, okay? So we have an uptrend, higher highs, higher lows. We're going to sell out of the money options, which are puts and put spreads, and we just define that. So if we sell a put under support, I'm agreeing to buy your stock, and you're giving me money for that obligation, I'm assuming. So we do that in uptrends and sideways trends on support. We're going to sell out of the money calls and spreads in downtrends and reversals at resistance in sideways trends. I can teach an 8-year-old how to do that. And then I call it a cushion because the money that we're taking in our account, the stock can go against us, and we still get paid. That's why I use that reference. It's like an insurance company or even a casino. I don't like to say the market's a casino because we have a logical, disciplined approach. But in the sense of you collect money over and over and over again using your approach, whether it's a stock, an insurance company, or casino, and we're collecting money over and over and over again. And yes, we're going to have stop outs. Don't believe anybody who says they have 99% certainty. It's not reality. But these guys are in business to make money, and the P&L curve should go up. So just like our little kid here, you better stay away from my short strike. And as long as it does, 100% profit. So here's just another beautiful way of showing you what we're going to do here, of selling puts and put spreads around compelling terms. So, Greg, your master trader, swing trading course teaches objective technical analysis, but this is our starting point of selling options, whether it's 10 days to expiration or 2 hours. We are waiting for a bullish intraday reversal. And the cues today, we'll show you when we turn over to real charts, which we do in every session. We just want the confidence to say that looks like a low for the day. And then we sell an out of the money put. On 0 DTE day, you can either do it naked if you don't have a problem with buying power, or just buy a real far out of the money put where you're only paying pennies for it. And then the difference of those two numbers is what goes into your account. That's your potential maximum gain, as long as these patterns expire above this green line for a couple hours. That's today's strategy.
It's the most simple thing in options. I didn't realize it until a little while because everything in options seems so complicated, but the concept of a credit spread is so simple. And, the reason I asked about the NDX and the leverage, Dan, is that I know you prefer the spiders versus SPX, but, if NDX is like SPX, the premiums are so juicy as they were this morning that you can get so far away. And if you can read the chart,
Right.
to me, I'm like 99% sure it's never going there. And for as long as I've been doing this, I can only remember one time of being wrong myself. And boy, was it a sweater because of that leverage. It cuts,
Right.
deep in one direction. But, but still the odds of being right, if you can read the charts and a few basic option things, the odds are overwhelmingly in your favor.
Yeah. Marcel, we'll get to your question in a minute. All right, so here's just a little checklist, and I have a couple of examples to show you how we do this. And then, as always, around 12:45, we like to go to real charts and answer your questions and look for new opportunity for the rest of the day. But here's a nice little checklist for today's strategy. Scan your universe, scan gaps, news, earnings. Earnings stocks are going to have higher volatility when they report earnings, either the prior day or the morning. And then we usually put these on in the first hour. I always start with the daily and then we drill down. But if you have no overnight risk and we're just calling a short-term top or bottom for a couple hours, these are the key time frames that you're going to be using. The hourly, the 15 5-minute charts for entry. We'll show you on the cues here in a few minutes. If you have a bullish setup, then we're continuing through our checklist. We're going to be selling out of the money naked puts or spreads, the opposite for calls. Liquid options. Liquid means tight bid ask spread, and that's what makes the spiders, the cues fantastic. The universe, Apple, Facebook, Cisco, Intel, Microsoft. I mean, create a list of just 20, and every expiration day, just scan those 20 for what we're showing you today. You want to have adequate. I call JUICE. It's just my acronym for the premium receipt. How do I define that? Well, we only have an hour together here today. I can't get into all that today, but we look at the premium received, and then this is you, Greg, and me. When we're looking at something, the compellingness of the pattern for the premium that we're getting, of whether it's 6 hours to expiration or 2 hours, whatever the case, I love when Greg and I are in agreement to say it's a no-brainer. Put on the trade and manage in between. So that's this. Follow your trading plan once you're in it. Marcel was asking about assignment risk. If it's the if it's an index, it's cash settled, so you have zero assignment risk. If something closes out of the money, it should expire at full profit, but I have one slide coming up. There's still a small, slight assignment risk if it does a post-market big move. So you just got to be aware of that. And a number of the ETFs trade until 4:15, so keep that in mind. A couple of examples, and we don't need to cover them all because we just find these over and over again. So here was a bearish gap, a bearish island reversal. This one was on earnings on a Friday expiration, so it was on our watch list. So once it gapped down under this green bar, it is totally on my watch list. So this is a 15-minute chart. You can use a 5, and we put it in a thumbnail, which is just a blank a blank chart, and we were sitting there watching for our entry. And since we had a bearish bias here, we're waiting for a bearish intraday entry. So Greg, I got arrows here, but and I love asking you this, putting you on the spot. But once it traded under this green bar, what do you think the odds are of this going back up here to 1720 is?
0.
And this is noon, so let's just call it 4 hours.
0.
So explain that. So.
Because everything as we do is based on the chart. And look, I'm exaggerating because anything's possible, but excuse me. I mean, I look at those charts, and I've looked at hundreds of thousands of charts over the 30 some odd years, and it's all based on probability. And I look at that kind of chart and I see the green bars ignored and failure to go up and so on. And just based on historical patterns, the probability of going back up there, maybe it's not 0, but it's pretty damn close.
And we're odds traders, and we're showing our approach in the checklist. And this was a perfect entry at little after noon. We sold a $20 Y. And so to remember the other chart, we're selling a 1720 call option. We're buying a 1740, and that's called a bear call credit spread. We're taking in $1.85 a share. So folks, even with one contract represents 100 shares, $185 hits your account immediately. And that is full profit as long as it closes below 1720. This is a strategy that you cannot orchestrate with buying or selling stock. We're selling out of the money call and put options with the charts with a high probability opinion that it ain't going there by the end of the day. That's what makes this such a beautiful day trading strategy. Here's another one. This was Tesla right here, and this is, I don't know if it was earnings or not, but you can see here, starting with the daily chart, it went up, I have 3 sideways bars. I have a bullish, this is pre-market, these dotted lines, bullish gap pre-market, sideways. Greg, I got a memory like an elephant, and this one came from you. I remember these 2 bottoming tails. After taking out the pre-market low, that's when you type in the green room, this ain't going down.
And I say that like it's 100% impossible to happen. I know we laugh about it, but when you see something over and over and over again, you have to have a strong belief about what you're doing, though. Otherwise, how can you do it? The balance with that is there are days I'm wrong, and that's why we have a stop loss.
Yeah, and actually Chris is asking that right now, and it's a fantastic question. He says, okay, superstars, what about the 1% chance it does go in your face? Do you have a complete loss? The answer, Chris, 1000% no. We have stop losses. The only way you're going to have max loss is if it closes below your long strike price. So that in this example, that's 755. There's no way we would let this thing go to 755. So we would either use an adjustment strategy or we would stop out. And because of time decay, the stop out might be at a gain. Okay, so no, and that's one of the myths of selling options that people say, oh, you've lost your brain because the potential risk to the potential reward is out of whack. Well, textbook it is, but it's the same with buying Apple at $124 right here. That what if Apple goes to zero? Then you've lost $124. Well, it ain't going to zero. I got a stop loss under support. I'm just showing you this. These are what we call intraday reversal periods. And it's when just the normal movement of the stock orders and filling things, we look for turning points. So these we put, I would say in the morning, Greg, the majority of the time we're putting these on, probably in the first or second reversal period. Although we can sell them at we get a 3 p.m. or 2:30 breakout on something. Yeah, we'll sell a put spread for 90 minutes.
Well, that's the thing that I was explaining it during the intro is that, I experienced that myself. And when you see it with your eyes, like understanding a concept or a strategy, the theoretical is one thing. Living it is another, meaning, so the concept of time decay related to options. And we use that, but we also use chart patterns. And I've seen where, hey, I want the best chart pattern, and I do if I'm trading, the futures, that opportune moment, which I waited for today and finally came, and it paid off very nicely. But that waiting period related to a credit spread, okay, I've got the great pattern, but all that extra hour deteriorated that spread significantly,
Right.
even though prices didn't move that much.
Melting ice cube.
Yeah.
Yep. All right, so here's an example, powerful uptrend, but far from the moving averages here. And we're just watching it. You just set an alert. And you can see here the first 15-minute bar of the day was a big bearish bar. And so this was a bear call spread candidate. Just for a couple hours, we're saying, I'm going to sell this call spread. I'm taking in 48 cents a share. So, let's say if you did a 10 lot on this one, $480 hits your account as long as this stays above the day's high. 2 hours later from this time decay that we're talking about, we're already at 50% of max profit. So we might cover half, move stop break even. And that's one management tactic.
I think, Dan, this morning, so if you're not aware, on YouTube, Dan and I are on there every morning at 9:00. Monday, Wednesday, and Friday, I provide the analysis for SPX credit spreads. And, so based on what I said below 4,000 should be a no-brainer. And I think McGraw posted in the room that he did the ones I suggested, and he was at 50% profit, I think, well, long before we got into this room. Right. So, and it wasn't moving that much, but it wasn't going down.
Right. So this is Amazon, big earnings gap. And so we would never swing short this, but today's a different strategy, right? So here's my pre-market holding strong into the open at 9:30 Eastern time. It's sold off. Big unfilled gap here. The volatility's off the charts because it's earnings, and it gapped up big. So the calls are very juicy, is the word I explained earlier. So write all these topping tails and see, everything we do on the timing is based on technicals. So we had an ugly 2-bar fall here. All these tails are saying it can't go up. And then right when it broke down here, we sold a $20 wide, 20.90. So Greg, same question as the other chart. This is 2050 right here. We sold the short calls $40 higher. And we put a stop over the pre-market high and we manage in between.
No brainer, Dan.
Yeah.
But what Dan is saying, the tails, I put little arrows on them because those are the tells, like in a poker game, the tells that, they've shown their hand or their losing hand, so to speak. In this case, is that every time it tried to go up, it formed a little tail on the top. And that happened, that's a 15-minute chart that happened over the course of an hour. So, right, the opportunity to take it higher, what didn't happen over the course of an hour? And somewhat similarly to this morning, was a nasty gap down. It could have kept going lower. And over the course of an hour and a half or so, it couldn't go down. And so that's when, in the green room, we did the futures trade long, or some people did the spiders, because it was just, they can't take it down. They can't take it down. And so it reaches a point where, look, if it ain't going up here, it ain't happening. And that's where you got to say, well, I've got enough information, and you press the button to see what happens. And, but again, in this example, where those arrows are over a period of time, the institutions, traders are trying to go higher on that gap. They can't do it. So the psychology of that is, hey, at some point they're going to give up because they're not getting paid. And that's what we're reading on the chart.
And could it come down and snap right back? Of course it can. And that goes back to our stop losses then.
Dan, we've seen so many times where that happens because of the time decay. You're making money, even though it went up against you.
Absolutely. And that's one of my favorite sayings. I have a testimonial on that in a moment. This is something you put together, Greg, one time when things were just crazy. This is an hourly chart. They were just, gapping up and down and up and down, and it would make you crazy how to day trade this even. And that's why I'm showing it to us, because every single day, even though there's not a good directional setup, we could discuss, we don't have time, but on every single day, we could pick a point where we could say, all right, that looks like the low for the day, that looks like the high for the day. And then there are candidates to sell these 0 DTEs. And this is your word, Greg, so I gave you a little icon here. Greg's right. So we're trying to pick levels and stay away from that danger zone, which is above resistance or below support. That's the danger zone.
And we look at different things, even moving averages, which are subjective. A 50 MA on a daily chart of the spiders is a reference point, and then we utilize actual price reference points. So the more, these reference points or stop points that we have to block us, from we're in the danger zone, it should never get to the danger zone. So that's one of the concepts that we look for. How many lines of defense do we have?
Yep. A couple more examples. I mean, we could talk for hours. This is a 15-minute chart of the spiders, but similar to the other one. So here was a 180 reversal moved up. That would be a good put spread. This was, a small little M top, a breakdown, sell setup. That's a no-brainer call spread candidate. The very next day, we have a W bottom. That's a no-brainer put spread candidate. Here, very bullish gap up, came in, support, bullish reversal, put spread candidate. I mean, so here, there's 4 days in a row that are amazing credit spreads. Yeah. So yeah, you were highlighting these. I mean,
Yeah,
those.
someone on YouTube was asking to show the 1, 2, 3. It's such a basic pattern. It's a wide range bar and then an inside bar and then the continuation.
And,
But that's got to revolve around the trend and the rest of the pattern.
and both of those that you just circled there, Greg, would be fantastic, day trades, whether it's stock or options also. Those are both beautiful setups there. David, yeah, it will be recorded. We'll send a link out. All right, so here's, Greg, I told you that's one of the beautiful things. This is a complete email from somebody, including this this guy Roger sent this in the email. I made money and the stock went against me. And it's like, this is an absurd strategy, guys. I mean, come on. We're selling these out of the money put spreads. It went against me X number of dollars. And because of the time decay, I closed it out. It hit my stop and I still got a profit. That doesn't exist in trading directionally, long or short. But with this strategy, it does. So many examples here, a bearish gap here, then we put it in a window, follow my checklist. I'm waiting for a bearish entry. So it went up here in the morning, failed. Topping tails couldn't make a new day's high. All these topping tails couldn't make a day's high. Right when it broke down, sell your call spread, manage in between.
So look, gap down. A lot of traders think buy the gap down because it creates a void. And it does work for scalps. But, as I explained before, over a period of time where you couldn't take it higher, you couldn't take it higher, you couldn't take it higher, at some point, people just give up. So we're just reading the chart to say, hey, this is at a point where they're going to give up. How we enter the position.
Manage in between. These are just some of the fallacies. Trading short-term options. Some people like these longer-term ones I mentioned. Gamma just refers to the speed of the directional risk, but it's not a problem to us in this strategy as chart readers. If we enter a breakdown and it starts moving up, well, of course, gamma's going against us, but we have our stop loss in our management tactics. So this is a misnomer. Selling short-term options is incredibly risky. That's the most time decay. If you're using charts or approach, that's the least risky time to do it. Greg, I'd rather have risk for 4 hours than 4 weeks. It makes no sense to me.
Well, it didn't make sense to me either until I listened to their method, or as it was explained as the strategy, that most of these option services don't believe in using charts. So for me, I think that's ridiculous, but their reasoning is, why go out all that time? Well, because based on whatever they're looking at, you got to give it time to work out. Well, as you like to say, Dan, hello, McGraw. If you looked at the chart, you'd be able to figure out, when it's getting ready to move. And so they don't want to look at the chart. That's their method, whatever. But, utilizing a daily chart and with zero DTA, then incorporating that analysis into an intraday chart at the right moment, timing is everything. So without those tools, I can understand why they wouldn't want to, or would promote against doing anything short term, because they don't have a way of analyzing it. But I've seen plenty where the things that they suggest are totally, against the chart, and they don't work.
Yeah, I got an email from somebody one time. They said, They said, this makes no sense. Who would sell you an option that expires in a few hours? Pull up the option chain right now on anything you want. Well, NDX and SPX, are spiders Qs, because today's Wednesday expiration, not Friday. But there's always a market. There's always a bid and an ask. All right, I'll go a little bit quicker here. Again, it's the same concept. Beautiful gap up here. This 15-minute chart of the spiders totally suggested lower prices. A gap deep into resistance and then taking out the 15-minute high, and then we sell a put under the prior day's low. It's just a no-brainer. It's a no-brainer setup based upon our technical approach. And so we sold this, it looks like $8 wide, took in 52 cents, closed it for, made 440 bucks in hours. All it has to do is stay above this support and we make the money. All right, so our weekly options trader, the sole purpose of this advisory letter is to sell options, whether they're naked or most of them are spreads, with the charts, just like we're showing you, that expire 10 days or less. Today, we're just showing you 0 DTE, but this is the advisory letter where you get those alerts, and then we send them out. We send a screenshot of the chart, we tell them the exact strategy, and we send it through Telegram. So you get it instantly. Cues here, whenever we have a bottom in the spiders, this is kind of a go-to that I also love doing. VXX is the volatility. And we'll finish here with our good friend McGraw, Dr. Paul Inkalis. He's traded over 25 years, and then he joined us to combine our approach with his. And look at his success and some comments here. He loves SPX. He's the one that Greg mentioned did the SPX on spiders 0 DTE today. I've had a much higher percentage since joining Master Trader. I've been a long-time trader. This old dog has learned new tricks. I love that. And he sent me this, many months ago, but still, check out his accuracy. 97% win rate. Yeah, here's his losses, here's his gains, 62 of 64. And you cannot have stats like this by accident. You have a methodical method, which is what we're teaching today. And also, Greg, just to give a heads up for next week's MT Live, something McGraw also uses in his methodology, which he actually brought to us and we liked it, and we're going to do an MT Live next week. It's a company called Spot Gamma, and they use these gamma levels, which is where, market makers have to hedge their positions. So we take that information, combine it with our chart analysis, and it just increases the probability of the trade working out. So stay tuned for next week. That's what we're going to show you. Yep, amazing. Just the one comment I told you I would mention to you. The only 100% way not to get assigned is to close it before 4 o'clock. Even if it expires worthless, the option holder still has the right to make an exercise notice by the deadline of his broker firm, which is typically an hour after the market. They would only do that if the stock moved in their favor. But, we're just full disclosure. We typically, unless it's far away, we tell people just close it at a penny, just so you can go to the beach and not have to worry about post-market movements. But SPX and NDX, they are cash settled. And that's based upon the 4 p.m. settlement price. Even if you have to wait a few minutes for them to calculate that, So you have zero gap risk in
That
trading.
thing gets closing in on that 4 o'clock close, it better be worthless or close to it, because you don't want to be sweating that. And I've done it once, just not pleasant, you know.
Well, and you know what, Greg? I mean, the sweating you is relative also, because even if you did get assigned, not assigned, if you got cash settled at a loss, it should be so close to the short strike that the cash settled loss should not be that big. You know, I think the bigger problem is if it rips, you know, $5 in your face in the last 5 minutes.
Exactly. It's when they rip is when it rips you.
Right. All right, so we're done. We can look at real charts now, but you know, Greg's amazing swing trading course, it teaches you how to read literally objectively candlesticks, trends, patterns, support, resistance. It's the starting place for our methodology of trading anything: stocks, options, currencies, commodities, Bitcoin, a bag of rocks. That's our starting point. And then today's section, obviously, is now you take that technical information and we're selling options and spreads around it. And we have 2 courses that teach you that, and then you know, this is just a combo. It's the Mastering Advanced course, which is a very detailed 12 module comprehensive course with 3 months of our live trading room, 3 months of the weekly options trader. Okay. All right. And just as Greg's getting ready for his putting up your screens, then you can read some of these things. These are testimonials about Mastering Advanced Credit Spread course. You know, people love it. You can start out with the advanced, which is a 5-module course, and you know, 99% of the people then say, oh, okay, can I upgrade it to this mastering course, which we allow to apply the tuition towards it. All right, let's take a look at the markets and answer any questions of yours and look for new opportunity. You know, it's going to be harder here at approaching 1 p.m. after the markets have been rallying for, you know, pretty aggressively, at least the Qs and the spiders and diamonds from the day's low.
All right. Someone on YouTube had asked about this. Let's see what they're saying. This is a swing. It could be. Wait till tomorrow, see if it trades above the high. Not one of my favorites, but it's a downside shakeout. So could pop a little bit. So this morning we could cover down, you know, this is.
Yeah, I mean, well, show them the cues. Why would you show them? Yeah, whatever you want.
You're right here.
Yeah, so
Diamonds.
show them when we were recommending selling either out of the money put or a put spread this morning.
Well, you had asked me around here, and I wasn't so sure at that time. And you know, what I explained was, I think you were talking about selling a 315 or a 314 or
313 at the time.
313.
Yep.
So what Dan was asking about, and Dan, I've told you plenty of times, you better off not even asking me, because you know, I'm looking for things more like this, what I traded on the S&Ps, which was all the way over here as it broke out above the highs.
Right.
And so it required, you know, all of this time for it to set up with this bottom. Whereas, you know, at the time when you mentioned it, it would have been the most opportune time that it was way down here, but I wanted more information.
Well, and then on the third bar, we got it. You know, Third bar, which was 30-minute high, we were looking at doing it again, but with a tighter stop, a tighter short strike, the 315s, right?
Yeah, so was this? I don't know what the other strike was, but just to reinforce what you showed earlier with credit spreads, what was the lower strike?
I just go down where I only have to pay a penny. So I don't know, it could have been $7 lower, it doesn't matter.
So that's a good point, meaning with credit spreads that are going out, say 10 days or more, you're looking at the distance between the strikes because that's your max loss. But with a 0 day to expiration, we're not so concerned with that because we're just looking to, we're very confident in what we're doing there. So, it doesn't matter if it's 20 wide, you just have to manage it. You're looking to get the distance between the strikes, the premium. So, selling more expensive, buying cheap, that's the money that goes into your account. So we're not so concerned with the width of the strikes.
Right. The sole reason of doing it is just for less buying power consumption at your brokerage firm. That's it. So only pay a penny. Go out as far as it takes to only pay a penny or two.
Yeah. So the Qs were leading this morning, right? Because those are the ones that were beat up the most recently. And they, bottomed out and been leading the way up. So one of the things that we look at, what I look at with Qs is, well, what are semiconductors doing? Or the XLK kind of gives you clues, but semiconductors especially, and they were moving up very nicely. So this is the type of thing that we look at. So with SPX, there was one of the, besides the patterns, there's a pivot low down there. I knew the 50 MA was down there, and this 4,000 big whole number with big open interest. So the idea, and it's on YouTube, the recording is there, and there was pretty good juice because of the way things had moved yesterday into the close. Down below 4,000 was what I would call the no-brainer. Spreads down there, it's just not going down there today, because as we look at these patterns and just look at the size of a move and what's probable and how far away you can get besides all the other lines of defense, they're not likely to go down there. And so those options now were, they're not, I don't have it in front of me, but they're not totally worthless, but I bet you they're close to it.
Well, Greg, just to show maybe the mechanics, maybe go back to that and show them selling a call spread over the week's high. What do the numbers look like? Even though,
well, there wasn't really any premium because I looked at that this morning, whether there was something up here. And, the trade was really on the downside because of yesterday's initial move to the downside, which opened up, expanded the juice, as you call it, of the premium to the downside. So when I looked at it this morning and I looked, wow, there was juice down below here. That's a no-brainer. And it was just unlikely to go down there unless, it was like a market crash, which, and besides that, the move that occurred yesterday, it already moved quite a bit, and then the gap down, and then the little continuation, just it wasn't going to go down there today.
well, I mean, candidly, what I was wanting was an acceleration with for 30 minutes of selling or some type of downside shakeout, and we got the latter.
Okay. And one of the things, this could go lower in the afternoon. You can see as this begins to form these pivots here, these red dots, which just denotes 3 lower highs to the left and right. And now there's 2 of them. And now so far it's ignoring them,
Yeah.
but
How?
you
Yeah.
can't get
Minutes.
you can't get caught up in, especially as an intraday trader, this strength and thinking, oh, that's going to continue to the end of the day. This can change dramatically as we get past the lunch hour.
Right.
And if it stops going up, people can start selling aggressively. So you got to keep that in mind. And so especially with a credit spread, at this point in the day, you could be done with it, closing it out for, whatever it is. If it's a nickel or a dime, you have no more risk. And because if this starts to drop fast, well, it depends on how far away your spread is. But if you had looked like here, the premium was huge, and you might get attracted to that, thinking, okay, you get that money. Well, you will get the money in your account, but if it starts dropping fast, boy, you'll see how fast your money goes away.
Yeah. Unrealized loss. Right.
Yeah. So then the hope mode is a trap. But anyway, the idea behind these 0 days to expiration credit spreads are very attractive because, you've got hours of risk. You're looking at these patterns that are setting up. Is it going up, down, or sideways? One of the first slides we looked at, and then looking at basic candlestick patterns. We don't use indicators. There's no need for them. So it's relatively simple.
Well, Greg,
Once you understand the patterns.
Yeah, look at the breakout failure of spiders at all-time highs. That was a no-brainer. Call spread under the green bar.
Yeah. So what we look at a lot are what we call shock patterns as to what were people thinking. And go back and look at the YouTube this morning, because I talked about this pattern and why this was so significant, this break, and why we were looking for the turn, and we were putting on many shorts yesterday at this turning point. So, there's no time to explain all of that, but go and watch the video, because I have explained the significance of this breakout failure. Ends today, Gerald. We always look for spreads that close out today. I don't do it personally, but McGraw is a bit more aggressive, and he'll put on one for Friday on Thursday, depending on the pattern.
Yeah, right, if the pattern supports it, of course.
Right. Yeah. So I like to see what's happening in the morning, and closer to the no-brainer trade as possible. Well, sometimes you miss it, the Q's trade, Dan had it nailed. And, when he mentioned in the room, but I wasn't doing that one because I wanted more information, and it just kept going. So, there are choices, and my choice was, focused on here. And as it bottomed, I utilized the futures contract, which one of my favorites. But join us in the green room, and you'll see us explain this, do it in real time. And, not to mislead anybody, we do have losing trades. Everybody does, but you'll see how they're managed in real time, what's taken. We do lots of swing trades, so it's not just credit spreads. Lots of swing trades held over days and sometimes weeks. So we're not a one-trick pony. This is the way it's said. Whether it's swing trades, day trades, futures, ETFs, credit spreads. So join us. The education is priceless. And I hope you take us up on it. For $7 for a week to spend with us, you'll love it. Yeah. All right, everybody. We will be back next Wednesday. I'm sure you're going to love that show too. I'm so looking forward to it. We'll talk to you then. Bye-bye.
Thanks, everyone. Good trading.
For listening to Master Trader Live. If you liked the show, we invite you to share this video on your timeline Or tag a friend who wants to learn stock market tips. Stay educated with our free chart of the week, a weekly analysis or lesson sent right to your inbox. We're live every week, and you can subscribe to the channel and press the bell to get alerts. If you've enjoyed the event, please give us a thumbs up. Just visit mastertrader.com. That's mastertrader.com.